Hey, good morning, everyone. Marty Mazzora here. Tuesday, April 1st, 2025. Thinking that this might be my best shot for a midweek update. I could be throwing another chart of the day or two at you between now and the end of the week if I think there is something there worth sharing. So, kind of like I said on the end of week video, my monologues getting a little redundant and just keep reiterating the obvious risks that are out there that everybody's aware of in the market and in the marketplace and in the economy. Tomorrow's a big day. The Liberation Day, I believe, is what the president is calling it. And it is slated to be a whole slew of tariff activity. There is some debate as to whether it's going to be something dramatic and negative versus in a reciprocal fashion, raising tariffs on some, cutting tariffs on others. Whether they look at it from a sectoral or a country basis, I believe it's going to be a country by country basis. I do believe it's been quite the heavy lift in terms of figuring it all out. And I was kind of expecting that maybe we'd get an announcement of a delay while they continue to figure it out, but I don't think so. I think that it has been, widely celebrated or announced that yes, there's a big announcement coming tomorrow. Market's been having fits with it. Yesterday we opened down a bunch, closed up a bunch in terms of the U.S. equity market. Not great breadth. Not every sector closed up, by the way. And then today, similar action. Dow was down 400 points at one point, and not that we should be looking at the very concentrated Dow, but it is up 69 points, so 0.17%. The S&P 500 is up about 1/3%. So nothing huge other than the move off the lows from earlier today. So there seems to be maybe some optimism, or I would say probably some short covering out of fear that maybe it'll be a buy the news scenario. Sell the rumor, sell the notion that some bad news is coming, and then when the news comes, then you're looking at something else, and or maybe the news wasn't so bad, and then you buy the news. And if you're heavily short betting on a further breakdown, you could get caught on a rally and lose a lot of money. So maybe there's some short covering coming today. If there's good news tomorrow, it's going to be big short covering tomorrow. If it's bad news, you're going to see the market turn right back around and head lower. So we don't know what tomorrow brings, so that'll be interesting and certainly the topic of my end of week commentary. So before I get to the chart that you have in front of you there, I'll pull over my note from this morning and was looking for the Institute for Supply Management Manufacturing Survey for March, which came out this morning. And good old Peter Bookfar did a nice job for us kind of breaking it down. So the overall score of the survey was 49. Now, 50 and above means that the manufacturing sector is expanding, or that the sentiment from the survey suggests that the sector is expanding. Below 50 suggests that it's contracting, and I highlighted the key points. Of course, it's all about tariffs. The first 2 months of the year included a bunch of tariff front-loading. And therefore, the March aftermath had inventories rising to 53.4. So you don't necessarily want inventories rising, although it could suggest higher demand coming. But in this case, easy to credit that to purchases ahead of the pending or the tariffs to come. New orders touched 55.1 in January and stand at 45.2 in March. So 45.2 is firmly in contraction territory. Prices paid jumped by 7 points to 69.4, and that's the highest since June of 2022. And again, just to repeat, inventories expanded as companies continued to pull forward deliveries of materials in an attempt to minimize the impacts of potential tariffs. With regard to new orders, the Institute said that orders continued to slow as discussions about who will pay for potential tariff costs are the prime topic of negotiations between buyers and sellers. On the labor front, freezing and attrition were the primary tools used for the second straight month, meaning not big, massive layoffs just yet, just no hiring and allowing for the normal attrition apparently. Only one in the 18 surveyed industries saw a rise in employment, and that was primary metals, and that could be helped by the rise in prices. Pushing prices paid higher, driven by a dramatic increase in steel and aluminum prices as a result of the recent tariffs. And then among the comments that they feature in the survey, the transportation equipment starting to see questionable medium to long-term demand due to government policy, including retaliatory actions taken by foreign countries with foreign military sales. Customers are pulling in orders due to anxiety about continued tariffs. That's from computer and electronic products. The food and tobacco industry says that they're concerned over Canadians boycotting U.S. products, that's becoming a reality. The machinery space says business conditions are deteriorating at a fast pace. Of course, tariffs and economic uncertainty are making the environment challenging. Fabricated metal products, we suspect that our customers are trying to build inventory at current prices to get ahead of expected tariff and related cost increases. From appliances and components, tariff impacts and mitigation strategies are a daily conversation. Miscellaneous manufacturing, newly impacted tariffs are significantly impacting gross profits. Petroleum and coal products, worldwide economic instability has really begun to impact our oil and gas business. Bearish sentiment and tariff applications and costs have dominated discussions over the past month. Concern is whether or not demand destruction will occur with higher pricing, and that's from primary metals. So, folks, I've said it all along. If you really get serious about the trade war, on top of other ambitions, I just don't see how we avoid recession if indeed these things are going to last, a matter of, let's say, months as opposed to weeks and quick negotiations. So the handwriting's on the wall. You're seeing it, in the commentary from businesses, and it's something that we need to take seriously. Today, as I mentioned a minute ago, the market is responding positively to something this morning, and I think maybe it's technical, which I'm going to show you here in a minute, or just maybe the hope that there's been enough pain to maybe inspire something a little different than what's been suggested of late. And again, but I will repeat, the powers that be continue to remind us that they're not really that worried about the stock market right now, that they have other fish to fry, as they say, and that in the long run, things will be healthier in their view if they do the right things now and feel that pain now. Again, let me repeat, I'm not passing judgment on this blog one way or the other. I am essentially doing my job. We're doing our job as a firm, and that is to be very much on top of the developments and allocate accordingly relative to our view of the global risk-reward setup. And as you know, we have some concerns here presently. So let's look at the charts, and I'll let you go. So this is that daily chart of the S&P 500 index. And folks, remember I said that we could dance around this 200-day moving average. Remember right here, I said that a bounce to the 200-day moving average would be textbook, but then that bounce would likely fail. And remember, I was drawing arrows and then drawing them down this way. So right now, that looks to have been the right call, if you will. Notice that yesterday we got right back down to the bottom where we hit here earlier last month, and then kind of pogo sticked off of that. And then today, again, opened lower and fighting our way back here. If we get what the market views as good news tomorrow, I think a swift move right back up to this 200-day moving average would be in order, and we could break through it. And if we break through it with momentum, with all that short covering and people panicking back into the market, well, then we could get a nice rally. And it could go for a few weeks, actually. The fundamental backdrop, valuations, geopolitical concerns, and so forth, do not give us much hope that there's going to be anything sustainable in that snapback rally that we could very well see coming. Now, another reason to think maybe there's a nice bounce coming is because we're getting pretty darn bullish divergences on our momentum indicator. So here we have testing the recent low, but from a momentum, we have a very bullish divergence. And so, that suggests to me that odds favor a bounce and have favored the bounce that we've got in the last couple of days. Again, if it's not a rosy picture or rosier than anticipated, in here tomorrow, then that's these bullish divergences aren't going to mean anything. And we're going to bust back down through that particular support level. And there's not really much help between there and the bottom of this bear flag. And ironically, that bear flag takes you real close to this support back in here. Funny how these technicals play out. The bigger concern that I have, folks, frankly, is on the monthly chart. So when I go back to the 30-year monthly chart, which we've been spending some time on lately, as you can see, once it loads, we now have a sell signal right here on the MACD. And man, do you need to respect those sell signals when they come from a lofty level, like here, 27% decline, like here, 60% decline and so on. And we can see right here, we close the month with that sell signal on. Now, historically, there have been some periods where it wasn't too bad. This one was real ugly. This one was nearly 40%. This one was 20%. This one back here was only 16%. And still coming off a very overbought territory. And remember, as I pointed out, overboughtness is not something that you want to be investing into when we're looking at the monthly S&P 500 chart. Looking at the NASDAQ, similar long-term charts. We'll just look at the daily here. There's that bear flag right now. Looks like it's playing out in very textbook fashion. A lot lower, and again, funny, right to support is where that bear flag would take us. But we do have the bullish divergences on this one as well. And then the only other chart I have pulled up is that ISM manufacturing PMI result, and that's what I just read you Peter's comments on, and that shows it going below 50. And you can see, not always do we have recession when it drops below 50, but it does say something about the manufacturing space, that it is in contraction territory. So, right in here, like for example, back here in 2018, this was a manufacturing recession. The actual full-on recession didn't happen until COVID hit, and it was very brief because of all the stimulus that was brought to bear. And there's also the services sector in the U.S., and we're going to get that survey result probably tomorrow, I would think. I need to look at the calendar. And it's way up here at 55, so we'll see. I suspect that's going to contract as well. Whether that gets into recession territory or not remains to be seen. If it does, then suddenly the serious risk of recession is upon us based on the history of those two surveys combined. So folks, I will just do a hard stop right there. I appreciate you as always for watching and listening, and I will talk to you again at the latest, the end of this week. Take care. Bye-bye.